Welcome to the Daily Update, where I'll go over the action in the market for Thursday, June 1st, and then we'll see how things look for Friday, June 2nd. We had a pretty solid up day. However, on the intraday chart that I'll show you, it looks like a big U-shape. We've kind of come right back to where we were just a few days ago, but it has shifted things more positive. Now we have to ask, are we starting to hit upper resistance? And will that resistance end up pushing us back down? Then if we do go back down, are we going to shift back more negative? There's a lot of things to worry about right now, but as we always say, the market likes to climb a wall of worry. Before I get started, please note that I do have a supplemental video. It's over 3 weeks old now, but the charts are still really relevant to what's happening right now. I do have a PDF that you're welcome to download and follow along with the different slides and charts that I go through. I do also have a private Facebook group that you're welcome to join. I do have a poll that'll go until this weekend. And then in the weekly video, I'll go over the results of that poll. And then if you can't find me for some reason on YouTube, I also post on Rumble. Here is the channel. And then there's an interesting article that I link to in the description put out by Chris Shivako. So let's go back and talk about what happened. We did have a pretty flat open. The futures were kind of positive, then went kind of negative, so we were flat. We saw some selling right after the open. Prices fell down below the daily pivot at 41.80. We fell down below the unchanged level to go negative. We finally found some support at 41.75. As the day went on, prices reversed and went back above the daily pivot and unchanged level. We climbed above R1 at 41.95. Then we broke above 4,200 to get to R2 at 42.10. We didn't get all the way up to R3, which was calculated at 42.39. We closed a bit off of the high, but we were above R2. We were up 0.99% on above average volume, so that is encouraging. Our technicals, as I said, in the short term, switching back more positive right now. We've been chopping so much sideways that if we have an up day, things are more positive. We have a down day, things look a little more negative. Intermediate term is showing a little bit of improvement, and we're still doing okay in the long term. The markets are still dealing with this debt ceiling issue. Even though it is now passed the House, it has to go through the Senate. And then behind all of that is inflation and interest rates. And in Friday's session, it's going to be pretty important because that's when the employment situation report comes out. What are some comments that we can make? The debt ceiling deal, it did pass the House, and they're expecting that it will pass the Senate in the next few days. The last report I read said it will be over the weekend. The S&P did get back above 4,200. On a short-term basis, we have our usual indicators that are showing that we're extreme positive. The Stochc RSI, the Williams Percent R, the CCI 20, and the short-term stochastics. Intermediate term, the Sean Trend meter has turned back up and is extreme positive. The dollar was down and interest rates were also down. This also gave some support to stocks. We still have the yield curves that are inverted that we've been watching. Sentiment is positive. It ticked up from 62 all the way up to 68. And our trend, it's turning back more positive now. It's getting stronger. The green line's going up. The ADX is above its moving average, but they're still below 20. Our bias now is positive, and I've shifted our momentum over to mixed to positive because we have another down day that could shift things back quite easily. The economic reports that came out, we had the ADP employment change. It came in at 278,000, a lot more than the 160,000 that they had expected, but lower than the 291,000 we had last time. Weekly jobless claims came in pretty much as expected at 232,000. They expected 233,000, up from the 230,000 that we had last week. Continuing claims are up just a little bit to 1.795 million. Last time they were at 1.789 million. First quarter productivity, the revised version came in down 2.1%. They expected it to be down more than that at minus 2.7%. Last time it was down 2.7%. Unit labor costs came in revised up 4.2%. They expected it to be a lot stronger, being up 6.3%. Last time it came in at 6.3%. The IHS Market Manufacturing PMI, the final reading came in at 48.4. That's below 50, so it's showing some contraction. Last time it was at 48.5. The big one was the ISM manufacturing. Came in less than expected at 46.9. They had expected 47.1. Last time it was at 47.1. Construction spending was up 1.2%, a lot more than the 0.2% they had expected. Last time it came in up 0.3%. Some Isabel Net charts. This is kind of interesting, put out by Morgan Stanley, where they're trying to decide, are we going to break out to the upside, or is that a bull trap? Or if we start to fall and we get below the 40-45 level, they think that it will turn more bearish if that happens. Personally, they say that they think it's a bull trap. There's a lot of people that think that. There's a lot of people that are just really convinced that the market's going to go down from here. There are some things that they can latch onto for evidence to suggest that. However, there's a lot of evidence to suggest that we could go up from here as well. Then looking at the median S&P 500 stock short interest. These are people that actually go in and instead of buying the S&P, they sell the S&P, so they make money when the S&P goes down. It's not at a very high level right now. It's at 1.7%. We like to have a high short interest ratio because, as I always say when we show this chart, those folks that had to sell to get in, they have to buy to get out. And when we're really going up and they're losing money, they have to buy to cover. And we call that a short cover rally or a short squeeze. And that can produce a built-in sideline of buyers that have to react if they start to lose. Then we look at the U.S. stock index speculative futures positioning. This is getting pretty extreme pessimistic. These are speculators. So we tend to do the opposite of what they do when they show some kind of an extreme reading. And right now they are pretty extreme negative. That could give some support to the market. Then we look at investor sentiment, where we had been extreme negative and now we're starting to come up out of that. We're not getting overly optimistic right now. That could also give some support to the market. And then with the sentiment gauges that we look at, we're still positive and not extreme positive. Then June isn't always weak for stocks. This lines up with just about what we found in the Stock Traders Almanac statistics that I went through yesterday, where during a pre-election year, June has an average return of 1.5%, and it's usually up 61.1% of the time. When we're going forward, after we've been up greater than 8% going into June, we're up 1.2% going forward. And when you combine the pre-election year with being up over 8%, then we see an even better return. This chart is a little bit concerning. This is just an estimate. We don't know if it's going to play out like this, but it says the debt ceiling increase models to a sharp drop in liquidity. Once the debt ceiling is passed, and there are things that people don't like in this, there are other things people really do like. That is not what we're dealing with here. It's more of, are they going to get some kind of an agreement passed? They're seeing a real drop-off in liquidity, which could put a lot of pressure on stocks. We're also looking at the Conference Board consumer expectations. We had this report earlier this week where people are still pretty pessimistic overall. And then we look at the U.S. public debt to rise by $5.2 billion every day in the next 10 years. The blue line is the percent of GDP, and it's just going up and up and up, meaning that we're spending more than what our country is producing. And then the public debt is the dark blue line, which keeps going up as well. This is the estimate put out by the CBO. Edward Yardeni had a couple of interesting charts. The first one is the weekly report from Investors Intelligence. We're not extreme positive or negative. We're just about at the midpoint as of the end of May. He also had another interesting chart where he talks about a thing called STRG. That's short-term revenue growth, which is the red line, and it's showing some improvement. Then we have short-term earnings growth, which is the green line, also turning back up. And then long-term earnings growth, which is a projection. That is the blue line. And all of these are turning back up slightly. Just to understand this, I put up in the corner, revenue is the total money a business receives, so all the money you take in. Earnings are what you have left over after you take out expenses. And then it says analysts use revenue to determine income, while the earnings are used to determine profit. Then he also had, in an email that he sent out, little bit of commentary. He says, hooray, the government won't default on its debts. There are plenty of jobs. Unit labor cost inflation is moderating. That's what we saw in the economic report. The banking crisis is abating. Well, we'll have to see. Most of us still think that there's more to come, especially if the Fed keeps raising interest rates. The recession is still a no-show. That's true. We haven't officially gone into a recession. Earnings were better than expected during the first quarter and are probably bottoming during the current quarter. The FOMC will likely pause its rate hike, and I have a chart to show you about that for at least one meeting. He also goes on to say that AI will boost productivity if it doesn't kill us. That's kind of a tongue-in-cheek thing. They think AI might get a mind of its own and decide to kill us all. Summer is coming. No wonder the S&P 500 sailed to a new 2023 high today. So he's fairly optimistic about things right now. Looking at Real Investment Advice, their daily blog post, this chart shows the PE ratio on the top. And this is a couple of days old now. We're at 18.6 looking forward on a valuation basis. So we're not overly expensive when you take the future into account. On the bottom, it's kind of interesting. This is showing that there's not a real participation of stocks as we move higher. The percent of stocks that have a 14-day RSI that's above 70, it's not really going up. In a good solid environment, we would see this line a lot higher. And the percent of stocks that are below 30 with their RSI, that is really showing an increase. So there's a little bit of concern, but we've known this and we've looked at other charts that also suggest this is happening. This was interesting where it says banks now have over $500 billion in unrealized losses. And this comes from the FDIC as of the first quarter. Again, is there going to be more leading to a greater banking crisis than we've already experienced? Economic reports. We had weekly jobless claims where they're starting to go back down slightly. We're still below the 4-week moving average. Continuing claims are right on top of their moving average and have pretty much gone flat. Then looking at all of this together, the red line is the initial jobless claims, which continue to fall. We compare that to the blue line, which is continuing claims. Those are also going down. And the unemployment rate, which will be updated after Friday's session, that continues to be quite low. So this is suggesting that the employment situation still remains strong. Looking at the Fed, we're starting to get closer to this meeting now, so I wanted to update this. I usually go over this over the weekend. There's a 79.6% chance now that the Fed's going to leave rates unchanged. There's still a little bit over 20% thinking that we will raise them 0.25%. This is how it's changed just over the last few days. The dark blue is where we're at right now. The lighter blue next to that, that was a day ago. So you can see how that's changed. And then we have the even lighter blue, which was a week ago, and then where we were at a month ago. So this is really jockeyed around quite a bit. And you can see they're also playing around with raising the rate 0.25%. All right, getting into our charts, here's the intraday chart where we had a pretty much flat open, and then we went down, and it looked like, oh boy, here we go, but we found some support right here at 41.75. We came back above the unchanged level, back above the daily pivot, went above R1, above R2. R3 was up here, so I didn't put it on the chart. We hit the high, came down a little bit, but then closed above R2. Looking at the 10-minute intraday chart, where we were pretty much flat to slightly positive in the overnight session, things did look a little more negative, and then we just took off to the moon. And for right now, we are just treading sideways, pretty much unchanged. Large cap growth continues to outperform large cap value, and we're seeing a little bit of an improvement here where we had been flat over the last few days, but leading up to this move upward, we had seen some real strength of growth outperforming value. So for the day, for large cap growth, it was up more than large cap value. It outperformed with the mid caps as well as the small caps. And then this is interesting too. At the end of the day, we had consumer staples and utilities that were down. All the other sectors were up. These are more defensive. These are the things that did better in 2022. Now they're starting to show a lot of weakness and they're underperforming the rest of the market. If the economy was getting ready to really decline, we would see the opposite of this actually happening. Looking at sentiment, still showing that there's not a lot of fear when we look at the Ulcer Index. This is interesting though. People might be hedging. This is a 1-day chart of the equity put call ratio. We had a pretty solid up day, but people were buying a lot of puts to hedge their positions anyway. So that really spiked up, and it's also turning back up on the 5-day chart, which on the longer term version, it's also going back up. We're not really working off of a signal here. That's a little bit of a warning sign to have the equity put call ratio rise up on a solid up day. But when you look at the VIX, yes, we declined with the line chart and the bar chart, and volatility of the VIX is also declining across the board. We're watching this now. It's gone back down a little bit, but this is the ratio between the VIX and the S&P 500. We really only pay attention to this when it climbs above this dashed line. It has not done that, but it has spiked up lately. And then looking at the MOVE index, bonds were up, so the MOVE index was down. Stocks were up, so the VIX was down. The spread is climbed back up just a little bit, and here is also the S&P. The correlation between these two still remains very strong. This is also interesting and could suggest some kind of big move is on the way. The skew index is now starting to give us an extreme reading. The VIX measures things based on at-the-money options, where the skew index looks at out-of-the-money options. And when this really spikes up, sometimes that is positive for the market. You can see a couple of times here. Here it actually marked a bottom. Well, then we saw another time when it got to a really high reading, and this marked a top. So what is this going to do? We'll just have to see this all play out. Just know that this is showing that the market is expecting something. This fear gauge declined on Thursday, and the other fear gauge actually ticked up just slightly. And then we're still back to a risk-on posture for stocks. This ratio continues to go back up. Looking at our advanced decline line, still turning back up and above the moving average based on price, but we're still below the moving average based on volume. Another thing that's a bit of a warning sign, new highs. We went back up to where we were at just a few days ago, but we didn't see a real breakout in new highs, so our 5 period is declining and our 10 period is also declining. Accumulation distribution, though, is still positive above an advancing moving average. This is another warning sign. Even with the update, the advanced decline ratio is still below 0. We're still seeing a longer-term negative divergence with the cumulative advanced decline line, even though it showed some improvement, and the regular advanced decline line has not come back up to this trend line, at least yet. This look at the NYSE advanced decline line shows us underneath this advancing trend line. We'll have to get back above that for things to turn more positive. Then longer term, when you look at just common stock, we're seeing this negative divergence that we've been watching for a while now. Then when we look at the different markets, the NYSE showed some improvement, but is still below the moving average. The same is true with the S&P and the mid caps. The small caps showed some improvement too, but they're still well under the moving average. Looking at our trend and volume, the ADX is looking more positive with the green line on top and advancing. The ADX is above its moving average, but they're still both below 20 overall. Our shorter term ADX, we're starting to get back up to 20, and it's looking positive with the green line on top, and the ADX is above its moving average. Volume dropped off just a little bit in Thursday's session, but it has still been climbing overall. Our short-term analysis, here's the daily chart. We haven't really been able to break above this recent high. On the bottom, you can see where we were above average with volume. The Stochk RSI is now extreme positive, as is the Williams percent R. The CCI 20 is getting extreme. The CCI 14 still isn't there yet. We're still well above the 20-period simple moving averages on this chart. And then looking at our double and triple exponential moving averages, we've been able to get back above both of those. Our short-term stochastics is looking extreme positive. The intermediate term is doing better, and we're turning back up with the longer-term stochastic. The force index, after coming almost down to 0, has now bounced back up. That's positive. Intermediate term, we're still below this dashed line with the balance of power, but we did turn up. We were able to get back above the 50-period double and triple exponential moving averages, so that's more positive. The go-no-go system remains positive with dark blue bars. TTM squeeze also showing strength. The PPO still positive in the long and intermediate term, and we're still above 0 in the short term. Our Arun indicator showing a little bit of improvement. When the green line's pegged near the top, that means buyers are in control. When the red line is going down, that means sellers aren't that influential according to this indicator. But this is where we start to see some problems. The S&P McClellan oscillator has still not been able to get back up to zero yet, and we're showing a longer-term negative divergence. And the NYSE McClellan oscillator is above zero, but also seeing this longer-term negative divergence. The summation index based on price continues to fall because the McClellan oscillator was negative. We're starting to turn up again based on volume. So we're seeing a mixed picture on this chart. Is volume going to push the price indicator back up? Or with price declining, is that going to push volume back down? This summation index is based just on the S&P 500. This summation index is based on the whole NYSE, where it's showing a decline overall based on price and volume. The Swenlin trading oscillator turning up based on price, and we've crossed back above zero based on volume. The PMO is still positive overall. We're declining based on price. We're looking a little better based on volume. Our PMO study turning back up with the PMOs that are rising, ticked back up slightly with the buy signals, and we're flat to declining with the PMOs that are above zero. The Elder Impulse system has switched back to positive. The parabolic SAR system remains positive with the dots underneath. Slope is looking a little bit better above its moving average. The MACD also continues to be positive. Our oscillators, the ones that I'm really watching, are the longer term, TRIX and KST, where they continue to be flat. We're above all the plotted moving averages on our moving average tree. The Sean trend meter is starting to get back to extreme positive. This is also negative. The BPI actually declined on an up day. So this is just being participated in by a few stocks. Most stocks are actually declining. And the NYSE bullish percent index also declined, another warning sign. The Chaikin money flow continues to be positive and showing some improvement. Chaikin oscillator also showing improvement. The money flow index, after crossing back below 50, has now gone back above it. That's positive. Ultimate oscillator turning back up above 50, positive. The vortex has the green line on top, even though it declined slightly, but that's still positive. The RSI is above 50 and advancing, looking at the 14 and the 9 period RSI. On balance volume, we're still above this moving average. That's positive, but we're still seeing a negative divergence when we look at the 200-day and 50-day moving averages inside the S&P 500. The Copic curve remains on a buy signal, and the Pring bottom fisher is also on a buy signal. Looking at our Fibonacci studies, we're still above this 4170 level. That may provide some support if we run into some weakness. And we're above this 100% retracement level on our shorter term Fib chart. If we fall, we're looking at 4123 as possible support. We're above this 4156 level, which is a 50% retracement. If we fall, that could also provide support. Then longer term, we're trying to break out above this 4214 level. We closed above that. Can we stay above that and continue to go up higher? And then this is the downward sloping trend channel where we hit up against this, bounced back, came through it again, bounced back. Now we're on the upper side of this trend line. Can this build off of that strength, or is the market going to exhaust itself and start to fall back? This is what a lot of folks are really referring to when they look at a decline coming into the market as a whole. And this could still play out that way. But right now, it's turning back to looking more positive. Our different charts, the Heiken Ashi is looking more positive, as is the Renko chart. The Kagi chart is positive, and the 3-line break continues to be positive. Our other indexes, the equal weight, even though it did improve slightly, is really starting to underperform the S&P. We're still seeing negative divergences when we look at the Dow and compare it to the transports. That's longer term. This is using traditional Dow theory. Then I add utilities to traditional Dow theory, and the utilities continue to show weakness. When we look at a new take on Dow theory, we're still above this breakout line on the S&P 500, and we continue to advance with the NASDAQ. But the transports continue to underperform the Dow. That could suggest longer-term weakness. The big stocks are really outperforming the smaller stocks. The Dow is still above its 200-day moving average, but not able to get above its 50-period moving average. And it remains neutral with the Elder's Impulse system. The NASDAQ didn't quite exceed the previous high here, but is looking a lot better. But when you look inside the NASDAQ, the cumulative highs minus the lows, they continue to fall and we're below zero when you do a raw calculation. The NASDAQ bumping right up into this 50% retracement line. We have not closed above that yet. Will this provide overhead resistance? Looking at the NASDAQ 100, also did not exceed the previous high yet. The Qs have switched back to positive. But when you look at the BPI of the NASDAQ 100, it actually declined. And we're right at this 61.8% retracement level. We did close a little bit above that, so that could potentially be positive. Can we stay at this level and even go up higher? Longer term, we're still hanging in there. We're above this anchored moving average going back to the all-time high when we look at a weekly chart. Small caps had a pretty good day, but still remain underwater when you just look at the small cap index, still below its 50 and 200-day moving averages. The Russell came right back above the RSI 50 level. That's slightly positive. The MACD is still rolling over and pretty much on top of its moving average. The small caps are still negative as far as the Elders Impulse system is concerned, and small caps continue to underperform the S&P. Here's where we see some strength. When we compare small cap growth with small cap value, the index running into a lot of trouble. We're breaking out now when we compare growth to value for the small caps. Now we look at the mid caps, still underneath both the 50 and 200-day moving averages, also underneath this monthly pivot level, where the mid caps have switched back to neutral with the Elders Impulse system. And here's where we're seeing some strength. Even though it ticked down slightly, mid cap growth is really outperforming mid cap value, even though the index itself has been under a lot of pressure. Looking at the home builders, we were up with the S&P. We were actually down a little bit with the home builders, so the ratio is declining, but the relationship overall remains very strong. We look at this chart for positive or negative divergences, and we're really not seeing anything right now. Keeping an eye on the financial sector, they were up over 1%, but are still in a downtrend. The financials are still underperforming the S&P, and the regional banking ETF is also underperforming the financial sector. Then looking at bonds, where interest rates are now continuing to fall, but bond prices continue to advance. And then looking at the S&P to the long-term bond ETF, we're still dropping down with our longer-term relationship, but we're showing a lot of improvement with the shorter-term relationship. However, the spread between the two is still pretty wide. Then we're also keeping an eye on this. We broke above the previous yield on the 3-month, and we're still up at a pretty high level. Last time this happened right before the great financial crisis. Is this a warning sign for right now? Then we're comparing shorter-term bonds, 3 to 7 years, with the S&P. When this is going down, that means bonds are underperforming, which means that the S&P is outperforming. Our long-term analysis, we're still underneath the red line with the special K. And here's our Zohorchak, a good old Midwestern family name. This is still generating a buy signal. Haven't shown this chart in a few days. It was negative for 2022 and the early part of 2023. And this is a longer-term buy signal that is being registered according to this indicator. Then looking at our long-term trend on the weekly chart, the MACD is still looking pretty good overall, suggesting that this breakout is legitimate. Now, it could ultimately fail, but the further we get away from this trend line, the less relevant that becomes. An update of our possible positive scenarios, we actually ticked down slightly with the S&P growth versus value. But when you compare the Qs to the S&P, it's doing quite well. Discretionary, not so much. Large cap growth is outperforming large cap value. Then our growth to value ratios. Large caps well, mid caps well, a little bit of improvement with the small caps. So the strength that we're seeing is not getting picked up by these charts. This is also positive. The S&P to utilities ratio shows the S&P is really outperforming. Other times when that's happened, that has given really good support to the S&P. But when we look at the 19-day exponential moving average of the advanced decline ratio, we're still below zero based on price, but we did climb back above zero based on volume. And then longer term with our exponential moving average of the new highs minus the new lows, that continues to decline, but it's still above zero because our indicator, the black line here, is still below zero. Then when we look at the broad range of the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows, we're still below zero overall. again, suggesting that there's not a lot of stocks participating in this upward move. Also keeping an eye on the 2-year yield. After spiking up and coming down, it had been going back up. Well, now it's been starting to go back down. Will this give some support to stocks? This is also another thing we're watching is the Staples to S&P 500 ratio. It continues to fall, but at the same time, when we spiked up and started to come down, a lot of the upward move had already happened after that. Can this give some support for the S&P to move even higher than it's at right now? So what's our outlook for Friday? We're still dealing with earnings season. The technicals are turning back positive. We have a lot of negatives that we're looking at, and we see a lot of longer-term negative divergences. We have the employment situation report coming out. That's the biggie for not only this week, but also for the whole month. And then the whole list of geopolitical events. We're still keeping an eye on that debt ceiling situation. We only have Friday now for the economic calendar with the employment situation report coming out. And then for June 2nd with the Stock Traders Almanac, we are positive pretty much across the board, with the Dow being up 61.9% of the time, the S&P 76.2% of the time, and the NASDAQ 71.4% of the time. And we're coming into that seasonality where we tend to see more strength in the market. But longer term, if we go back and look at what happened in 2011, we're right about at this level with the S&P. We saw some weakness after that, a recovery. And then late July into early August, we saw some pretty significant weakness. And the Shivago Capital chart is pretty much showing that same thing. So we need to be aware of this. We don't know if it's going to play out this way or not. But we just need to know that even though some things happened in 2011 that led to the debt ceiling agreement, after that, there was some real weakness that came into the market. So our scenarios, hard to go with the down one right now with the solid up day because the technicals are turning more positive, even though we have a lot of negatives in the short term and divergences in the longer term. And it's hard to go with the up one because with our ADX, we're just not trending right now. So we still have to default to the sideways or neutral trend. The ADX is strengthening. It's above its moving average, but both are below 20. That's the real gotcha right here. It is positive because the green line is advancing. So what are the warning signs that we need to be aware of? The equity put call ratio rose on an up day. Not in and of itself that big of a deal, but it's a little surprising to see that happen. The skew index is extreme. I showed the chart there. Is that a positive or negative thing? We're not really sure right now, so we just mark it as a warning. The new highs, new lows for the S&P, they're not expanding on an up day because we made that round trip. We haven't really broken out above price that we were at just a few days ago. We closed higher, but we haven't really exceeded those previous highs. The advanced decline ratio still remains negative. The BPIs are diverging from price. There are numerous negative divergences outside of the S&P that we can freak out about. There are also a lot of signs of weakness, not only in the S&P, but in other indexes. The VIX is still showing a lot of complacency. The advanced decline line for the NYSE, it's still below that trend line. And the cumulative new highs and new lows for the NASDAQ, they're going down as the NASDAQ's been going up. Small caps are underperforming when you look at the whole index as well as with mid caps. And then earnings season, but we don't know. That can be either positive or negative. And someday it'll actually be over. Positive signs. We do have positive seasonality and those setups. Those apply to the whole year. The Copic curve is giving us a buy signal, as is the Pring bottom fisher. The S&P did close above the downtrend channel upper line. So that is the resistance that a lot of people think we were going to hit and go back down. Right now, we're above that level. We're back to risk on as far as our posturing. Lower price levels may provide support. I tried to point those out with the fib charts. We can also look at moving averages and previous price levels. The S&P is outperforming utilities. That is quite positive. The NASDAQ and NASDAQ 100, they're continuing just to go up and up and up. Staples to S&P 500 ratio is declining, meaning that this S&P to Staples ratio is going up. And small and mid-cap growth, they're still showing quite a bit of strength underneath the surface. And then when we finally get this thing passed, if we already bled off what's going to happen with the debt ceiling, are they going to finally see some relief after the Senate ends up passing this thing? Or is that going to lead to a sell the news type of reaction? So our conclusion, The S&P, it's turning back positive, but there's a lot of negative things that we need to be aware of and negative divergences that we're seeing. In the short term, we're back to positive. Intermediate term, it's turning back more positive. Longer term, we still remain positive. So thank you. I hope you have a really good day. I will be preparing the daily video over the weekend as well as the weekly video and intermarket analysis video. So have a very good day, and I will talk to you in the next video.